Financial reporting quality, end of chapter questions from curriculum. Question number 1. In contrast to earning quality, financial reporting quality most likely pertains to what? Sustainable earning, it relates to earning quality. Adequate return on investment, earning quality. When we say financial reporting quality, it is relevant information that has usefulness for the users. So this is an element of financial reporting quality. So that makes B to be your correct option. Next, the information provided by a low quality financial report, mind it, low quality financial report will most likely decrease company's value. Company value is dependent upon the earning quality. If the company is generating sufficient earnings, the company value goes up, share price goes up. So decrease in company value, that will be caused by low earning quality. We are looking for the financial quality, financial reporting quality. This is not a right option then. This is related to earning quality. Indicate earnings are not sustainable. Earnings are not sustainable. That is a feature of earning quality. Low earning quality means the earnings are not sustainable. We are looking for low financial quality. Low financial quality report restricts the assessment of earning quality. Yes, this is the restriction in the assessment of how well the company has made an earning. This is our restriction in assessing the quality. It's the tool that we have to perform on financial statements. So financial statements that are of low quality, it will be a restriction for us as an analyst to assess the earning quality. That makes C to be the correct option. To properly assess company's past performance, an analyst requires high earning quality. High earning quality affects firm's value, firm's share price. High financial reporting quality, yes. To properly assess a company's past performance, an analyst requires high financial reporting quality. This is where he will base his analysis on. When you say both high earning quality and high financial reporting quality, one thing that must be kept in mind that financial reporting quality and the earning quality, they are distinguishable. Earning quality is the persistent and sustainability of earnings, affects the firm value. Financial reporting quality pertains to the quality of information contained in the financial statement that must meet the criteria of relevance and usefulness. So that makes B to be the correct option. High financial reporting quality, that B is the right answer. Low quality earnings. Low quality earning means earnings are low. Firm's value will fall. So low quality earnings most likely reflect what? Low quality financial reporting. Financial reporting quality, not the earning quality. Wrong. Low quality earnings most likely reflect companies' activities which are unsustainable. Yes. Unsustainable activities will result in lower earning quality, lower earning persistence. This will result in fall in the firm's value. Correct option. B is the correct option. Why not C? Information that does not faithfully represent company's activities. That is low financial reporting quality, not the earning quality. So that makes B to be the correct option. Earnings that results from non-recurring activities, gain on disposal, foreign currency gains, fair value gains on remeasurement of your held for trading securities, because normally it's done at the end of the reporting period, not daily basis. It's not a repetitive item. So earnings that result from non-recurring activities most likely indicate lower quality of earnings. Correct. Biased accounting choices, there is no such indication. This would, and if it happens, it will result in lower financial reporting quality. We don't see it here. Lower quality financial reporting against, we don't see any indication of low financial reporting quality. That makes A to be the correct option. Which attribute of financial reports would most likely be evaluated as optimal in the financial reporting spectrum? Conservative accounting choices. Conservative accounting choices, this will make your financial reporting quality lower. Emphasize pro forma earnings measure. Again, focusing on, this is earning management. This is earning management. This will result in low financial reporting quality. So which attribute of financial report would most likely be evaluated as optimal in financial reporting spectrum? Sustainable and adequate return. This is viewed as favorable or as conducive to financial reporting quality. B is the right answer. Next, financial reports of the lowest level quality reflect what? Lowest level quality. Fictitious and accounting that is non-compliant, it is outside the spectrum. Biased accounting choices. Lowest financial reporting quality. Biased accounting choices that favors the management view, what they want to show to the shareholders or to the users of financial statement. B is the right answer. When earnings are increased by deferring research and development expenses, research and development expenses are being deferred, being delayed. They have not yet been incurred. Research and development expense is being delayed. If you have incurred it, it has to be reported as an expense under the US GAAP. Because under the US GAAP, research and development both must be expensed when incurred. But under the IFRS, research is to be expensed, development expense can be capitalized if 6 criteria are met simultaneously. So you are just delaying the expenditure, you haven't yet incurred. Until the next reporting period, this choice is considered as what? Non-compliant accounting. No accounting violation has happened here. Deferring is purely management action, nothing to do with the US GAAP. You can delay an expenditure, it's perfectly fine. So this is basically a real management action to show a favorable result this year because the expenses have been delayed, incurrence has been delayed, so the current year result will be good. So earning management as a result of some real action. It's not just GAAP has assisted you in manipulating your results. So earning management as a result of accounting choice. No accounting is involved because expense hasn't yet been incurred. So that makes B to be the correct option. A high quality financial report may reflect what? High quality financial report. Earning smoothing, no. Earning smoothing is a bad thing. Low earning quality, that is possible. Understatement of asset impairment, no. High financial quality report shouldn't have understated assets, shouldn't have resulted in earning smoothing. Yes, earning quality might be low. A firm might have had setback or low earnings, but the financial reporting must be reliable with faithful presentation and usefulness. So that is true. Low earning quality could be present in those financial reports that are high quality. So that makes B to be the correct option. Perfectly fine. Next, if a particular accounting choice is considered aggressive in nature, then the financial performance for the reporting period would most likely be neutral. No, it's not neutral. You are being aggressive. Exhibit an upward bias. Yes, your earnings are higher. Your balance sheet totals and bases look good. So this is exhibit an upward bias. Upward bias is an aggressive approach and downward bias represents conservative approach. So that makes B to be the correct option. Which of the following is most likely to reflect conservative accounting choice? Decrease reported earnings in later periods and make more earning now. This is aggressive. Increase reported earnings in the period under review. Show more profits now. This is aggressive. Conservative one, increase debt reported on the balance sheet at the end of the current period. Increasing expenses, charging more allowance for doubtful debts, increasing your valuation allowance, increasing debt. This is a conservative approach. We discussed this a little while ago. That makes C to be the correct option. Which of the following is most likely to be considered a potential benefit of accounting conservatism? A benefit. When you're conservative, you are being careful, cautious. Careful, cautious will put you out of trouble. Being cautious. A reduction in litigation cost. Because you have been careful in your assessments, you are being conservative. You are being over cautious in earnings, assessments, earning management. So this would keep you out of trouble. A reduction in litigation cost. Conservatism reduces the possibility of litigation because you have been careful in in applying accounting choices and in applying your accounting concepts there. So you haven't manipulated earnings, you haven't deliberately shown more than the usual result that should have been. So that makes sense. Less biased financial reporting, no. Being conservative and aggressive, both are biased one. Upward bias, downward bias. This is incorrect. An increase in current period reported performance, wrong. Under conservative, the performance, the net income is lower. So B and C are wrong, A is right. Next, which of the following statement most likely describe a situation that would motivate a manager to issue low quality financial report? A motivation for a manager to issue low quality financial report. The manager's compensation is tied to the stock price. Yes, he will definitely do it. There is an incentive. There is a motivation for him to manipulate the numbers, to cook the books, to earn his compensation, his commission. True, we just can ignore the other options, but you need to read the theoretical one, the question that involves theory. I recommend you need to convince yourself if A is correct, B and C, they have to be incorrect, and you should have a valid reason for rejecting B and C. The manager has increased the market share of the product significantly. If he has, then he doesn't need to manipulate the numbers. There is no issue and there is no need to play with the numbers. No need to incorporate low quality financial reports. The manager has brought the company's profitability to a level higher than competitors. Things are good. No need to cook the books. A was the right answer. Next. Which of the following concerns would most likely motivate a manager to make conservative accounting choices? Now, attention to future career opportunities. If you want to enhance your future career opportunities, you have to show something good now. So that he will have to improve earnings now, but he is being conservative. Expected weakening in the business environment. In the future, the businesses will be in trouble. So he will be conservative now, but later his profitability will be higher than the industry averages. So which of the following concerns would most likely motivate a manager to make conservative accounting choices when there is expected weakening in the business environment in the future? Future looks bleak. So he will be conservative now, charge more expenses, book more liabilities, but later when things will reverse, he will have better performance than others. So this could be a motivation for him. B is the right answer, but why not C? Debt covenant violation risk in the current period. We are looking for a situation where he will use conservative accounting. There is no issue now. So why will he violate debt covenant? If he is being conservative, why he will violate certain debt covenants? Things are good now. He just wants to make sure that his future performance is protected. So being conservative is good. Next, so that makes B to be the correct option. Which of the following conditions best explains why a company's manager would obtain legal, accounting and board level approval prior to issuing low quality financial report? A very interesting question. A manager is about to issue a low quality financial report. He takes consent from legal department, accounting department and board level. This again reminds me of Enron. At that time when the fraud was committed, Arthur Andersen, one of the oldest audit firms in the US, now its history is gone, they charged $2 million every week for their services to Enron. Auditors. The lawyers, they charge almost equal amount of money from Enron every week. So whenever a big corporate fraud is planned, auditor is involved. That's what experience tells me as well. Lawyers are involved. The board of directors is involved. Because these are the people who are there as custodians. Auditors are supposed to say no. Lawyers are supposed to say no. Board of directors are supposed to say no. Audit committee is supposed to say no. In Enron, all those who were supposed to say no, they didn't say no. Auditors were involved, Lawyers were involved, the board of directors were involved, CEOs, CFOs, all were involved. A big, massive fraud like this is synergistic, involves these people. So if you want to commit a fraud anytime in the future, you have to bring these in, agree certain cut to them, and then you can definitely commit as big fraud as you want, but the consequence, I will not be responsible for that. Now we have brought in the lawyers, we have brought in the accounting department, we have brought in the board. So why would you be doing this? Motivation. There is no motivation. Maybe there is, but it's not shown here in the information. Opportunity. There is no indication that the system of accounting control is weak. It is justification. That lawyers are saying okay, accountants are saying okay, the boards are saying okay, so this is a justification for me to issue low quality financial reports. So yes, you're right, that's C. C is the right answer. Next, a company is experiencing a period of strong financial performance. In order to increase the likelihood of exceeding analyst earning forecast in the next reporting period, the company would most likely undertake accounting choices for the period under review. Now, this is an interesting question. Right now, the financial performance is very strong. So we want to show higher, better results in the future. So what is most likely the management will do? Inflate reported revenue? No, you will delay. You will be conservative now in order to show more favorable results in the future. So why would you inflate revenue? Your revenue is already, things are good. Why would you do that? Delay expense recognition. If you delay expense recognition, your current results are already good. How good you want them to be? We will delay the performance for the future. We will accelerate expense recognition. We will charge more expenses now to show lower earning, but in the future, when the effect will reverse, you will have better performances. So that makes C to be the correct option. Which of the following situations represents a motivation rather than an opportunity? Remember, motivation is an incentive to the management for committing a financial statement fraud. So which of the following situations represents a motivation rather than an opportunity to issue low quality financial reports? Poor internal controls, weaker internal accounting control, it's an opportunity to commit fraud. Search for a personal bonus. Yes, that's an incentive. That's a motivation that might push you to commit a fraud. Inattentive board of directors, opportunity. Weaker board of directors, they're least interested. It's an opportunity. So among these, the motivation is B. And that makes B to be the correct option. Next, which of the following situations will most likely motivate managers to inflate reported earnings? In which of these cases you will inflate your results? Possibility of bond covenant violation. If this is the threat, then you might manipulate your numbers to shape favorable results. So this is a motivation or an incentive or an impetus to change. Motivation, incentive, or impetus. Earning in excess of analyst forecast. If earnings are good, then there is no need to fudge the numbers. Earnings that are greater than the previous year, then good. No need to cook the books in B and C. B and C are perfectly fine. A is a motivation for you because there is a possibility of bond covenant violation, so you might cook the books in A. Not B, C are perfectly fine. Next, which of the following best describes an opportunity for management to issue low quality financial report? Opportunity. Ineffective board of directors, opportunity. Weaker system of internal controls, opportunity. No one really checks, opportunity. Audit committee, sleeping. So then when such a situation exists, it's an opportunity for the financial accounting managers to play around. So this is opportunity. Pressure to achieve some performance, this is motivation. Corporate concerns about financing in the future, again it's a pressure or motivation. So this is not right. B, C are not the options. So A is the opportunity. A is the right answer. An audit opinion of a company's financial report is most likely intended to do what? Audit opinion is not to detect fraud. Remember, audit is not for the detection of fraud. It's not to reveal the misstatements. It is to assure That's why it's called audit and assurance. It's an assurance that financial statement is presented fairly. This is the purpose of audit, and that makes perfect sense. C is the right answer. If a company uses non-GAAP financial measure in SEC filing, then company must do what? Give more prominence to non-GAAP measure if it is used in earning releases. More prominence? No. This is not allowed in the US GAAP. Yes, this is required. Provide a reconciliation of the non-GAAP measure and equivalent GAAP measure. A reconciliation is required. This is needed. Specifically, we read it in the reading. Exclude charges requiring cash settlement from any non-GAAP liquidity measure. Exclusion is not required. Reason, justification, and reconciliation is required as per the reading we discussed a little earlier. So that makes B to be the correct option. A company wishing to increase earnings in the reporting period may choose to do what? We want to increase earning. What we will do? Decrease the useful life of the depreciable asset. If the estimated life is reduced, this will result in higher depreciation charge, and this will depress your net income. So this is not the right approach. Lower estimates of uncollectible accounts receivables. Yes, when allowance for uncollectible account is reduced, charge against net income is reduced, net income will go up. B makes sense. Why not C? Classify a purchase as an expense rather than capital expenditure. When you expense out an item that could have been capitalized, your net income will be depressed. So C is not right as well. That makes B to be the correct option. Bias in revenue recognition would least likely be suspected if a firm engages in barter transaction. Barter transactions are very susceptible to frauds and errors. Yes, it is possible if barter transactions are involved, there is manipulation possible. Revenue is recognized before goods are shipped to customers. This is bill and hold. Clearly, these are deliberately done to increase revenue. So, bias in revenue recognition would be least likely. It is likely in A, in C, but not in B. Why? Because reported revenue is higher than the previous quarter. So, it is perfectly fine. It could have been lower as well. So, this is not the reason to be suspicious. This is not a reason to be suspecting anything is wrong. So, A and C surely are. That makes B to be the correct option. Which technique most likely increases cash flow provided by operations? We want to increase your cash flow from operations. Stretching the accounts payable credit period. Yes. Delaying your payments and collecting your account receivables as quickly as possible. So this will increase your cash flow from operations. Correct approach. Applying all known cash discount amortization against the interest capitalized. If you do so, since it's a non-cash discount and all adjusted against interest capitalized, it will lower your interest expense, increase your outflow, rather cash flow from operations will fall. Shifting classification of interest paid from financing activity to operating cash flows. Shifting classification of interest paid, an interest payment that was shown in cash flow from financing, it has been shown as a cash flow from operating outflow. This will reduce your outflow, the cash flow from operation rather than increasing. So B and C are not recommended. Delaying the payments to your suppliers, collecting your receivables as quickly as possible, running down your inventory by offering discounts, it could increase your cash flow from operations. A is possible. A is the right answer. Which of the following is an indication that the company may be recognizing revenue prematurely? Relative to its competitors, the company's assets turnover is decreasing. Assets turnover is sales upon average total assets. If the revenue is being recognized prematurely, revenue goes up, so this ratio should go up, whereas we are seeing decrease here. This is wrong. It should increase. Receivables turnover is increasing. Receivable turnover is increasing, means receivables are paying you more frequently now. So this doesn't mean that the sale is being booked fictitiously or your revenue being recognized prematurely. Yes, this could be the reason. Days sales outstanding is increasing. Now it takes more time from your customers to get the money. Probably revenue is being booked prematurely and the payments are coming after 3 or 4 months, whereas the regular payment period was 30 to 60 days. So this delay in the collection from the customer is the indication that we are prematurely recognizing revenue, and that's why the payments are now received at a much later date from our customers because we recognize revenue prematurely. This is a very valid reason, and that's the right answer. C is the correct option. Which of the following would most likely signal that the company may be using aggressive accrual accounting policies to shift current expenses to the later periods? Over the last 5 periods, the ratio of cash flow to net income. Cash flow to net income. Question is, which of the following would most likely signal that the company may be using aggressive accrual accounting policy to shift current expenses? If your net income is rising steadily because of aggressive accrual, higher net income every period, a consistent cash flow in the numerator will mean this ratio will decline over the period. So it should decrease each year if the company follows aggressive accrual accounting, because cash flow in total or from operation, let's say they remain the same. If net income is being artificially inflated through aggressive accrual accounting, the denominator will increase progressively, so this ratio will decrease each year. That makes B to be the correct option. An analyst reviewing firms with large reported restructuring charge to earnings should do what? Remember, gentlemen, future CFAs, when you're comparing two sets of financial statements or two reports, they must be based on some comparable foundations. Only then comparison is suited. So an analyst reviewing a firm with a large reported restructuring charge to earnings this year, 2021, what should he do? View expenses reported in prior year was overstated. Why? It has been incurred now. We just have to bring these two numbers or these two financial statements comparable. Something that is on equal basis so we can compare. So this is, we can't assume the prior year is overstated or understated. Disregarded, we can't ignore it. We consider making some pro forma adjustment to the prior year's earnings so as to make them comparable. Bring them on equal basis so that they can be compared. This is the right approach. This is the right approach, and that's why it's the right answer. So that completes your EOCs for this reading.